All right, let's start chapter 8. And so I'm going to go ahead and try to break it into 2 videos potentially instead of doing it in one, to try to help with you guys getting kicked out for not finishing the video. So you guys had the issue of if you didn't do the whole thing in one setting, that you couldn't get the points and you had to start it over. So I'm going to try to do smaller videos instead. So this whole chapter is basically about receivables and what happens when your customers do not pay. Also, there's some interest calculations in this chapter. So we're going to go ahead and get started with the pros and cons of giving your customers time to pay. So when you make sales to your customers, the optimal situation would be to get your money immediately. Like as soon as you finish the job, you walk out with cash in your hand and you're done. But a lot of businesses don't function that way, and they allow their customers to charge it and then they receive the money later. And so accounts receivable is a common situation, but there's some issues with letting your customers wait to pay. The main one being they may never pay you. And the issue with that is we have to go ahead and figure out a way to, how do we record like bad debt and what do we do with that? Obviously you lose the revenue. And so you end up in a situation where you did some work for somebody and then you don't come out with any money. And that's very sad. Very hard situation to deal with as a business owner. One of the other issues that you run into, you have to check people's credit to make sure they're okay. So there's some extra costs involved there. Also, the delayed receipt of cash becomes an issue because you make the sale to the customer and you might not get your money for 30 days or 60 days. And sometimes you have to pay your bills and you don't have the money from customers yet. And that's hard too. So another concept you can use instead is to do notes receivable rather than accounts receivable. So we will do some journal entries in this chapter dealing with notes receivable. Notes receivable is just like accounts receivable, except for it charges interest. So accounts receivable is your regular customers. Notes receivable are people that you are charging interest to. So maybe they ask for more time to pay. So if Lauren's my customer and her bill is 3 months past due and I keep calling her trying to get her to pay her bill and she won't pay her bill, I can convert it into a notes receivable instead of accounts receivable. And when I do that, then I'm going to charge her interest. I'm going to make her sign a promissory note. That way, if I have to take her to court, I have some kind of document that I can, give to the judge and be like, hey, she owes me money. So that's an option. So it's better than accounts receivable because it's more likely to stand up in court. So accounts receivable, we've been dealing with that account. Well, we mentioned it in chapter 1, but we've been dealing with it a lot since chapter 3 in journal entries and stuff. So this is when we are going to receive money in the future from our customers. The key accounting principle that relates to what to do with bad debt is this is the conservatism principle. And what we say in accounting is that we want to be conservative. And so we never want to mislead our investors. And so if we have accounts receivable sitting on our books and it's $100,000, then if on the average 5% of our people don't pay, we feel like we need to notify our investors of that. They need to know that of that 100,000, maybe 5,000 of it's never going to show up. Because we're conservative, we want to notify them that might happen. Also, we use the matching principle. And the matching principle says that when we have revenue, we need to match the expenses in the same period. So if we have revenue of 100,000 from customers, then one of the expenses of that revenue is the potential of bad debt. So what we have to do is we have to estimate what we think will be bad. And that's hard because we don't know. We don't know. If we knew the customers that were going to pay their bills, we would have never charged them in the first place. So if you know that a customer is shady and they're not going to pay their bill, then you just wouldn't let them charge it. You'd make them pay cash. But we don't know that information, and it does happen. And so even to the most organized, diligent businesses, there will be times when your customers just don't pay. And you attempt to receive the money and you can't get them to pay you. Maybe they file bankruptcy. When they file bankruptcy, you're not allowed to contact them anymore. You have to get in line in the bankruptcy court to get your money and potentially write it off. And so we're talking about write-offs in this chapter. So bad debt expense is the expense name that we're going to use when we have to write off customers. we are going to use what's called the allowance method because that's GAAP. So allowance method. So the allowance method is the method we use to estimate what we think will be bad debt. And so when we're trying to figure out how to do that, what we basically do is we look at past experiences with customers and say, you know, on the average, 3% of people don't pay or 10% of people don't pay or whatever. We could also look at industry averages and say that the average in the industry is 4% or whatever, and use that percentage. And so if you're a brand new business, you would use industry averages. And if you are established, you can use your past averages. You can always adjust your average if you're estimating and it ends up being less than you thought. In future years, you can use a smaller number to kind of get that number more where you want it. So what we're going to do is at the end of every period, so every month or every year, whenever we do financial statements, we are going to do an adjustment. We're going to do an adjusting entry. So we learned adjusting entries back in chapter 4, and we learned that it was like supplies expense and supplies, or insurance expense and prepaid insurance. So this adjustment is going to be for bad debt expense, and we will do this along with depreciation and all the other adjusting entries. So you will use bad debt expense. And then the other side of that is called the allowance account. And so your credit side of that will be the allowance for doubtful accounts. You can call it allowance for doubtful accounts, uncollectible accounts. I just call it allowance. And so we will estimate what we think will be bad based on a percentage of sales. And so allowance is the second contra asset that we learn about. So we already learned about a contra asset back in chapter 4, and that was accumulated depreciation. So it began with an A, just like allowance. And so those two accounts are both contra assets. They offset an asset, a contra asset. So accumulated offsets equipment or building or whatever you're depreciating. And then allowance offsets accounts receivable. So I have accounts receivable of 100, but I think that 5 of it's not going to be collected. So my actual accounts receivable is 100 minus 5, or 95. So allowance does not get closed in your closing entries when you close the red ones because it's a permanent account. So every period you just carry it forward to the next year. And so we will write off customers through the allowance method, and I'll show you how to do that on the next page. So our write-offs occur by basically eliminating the customer. So when you eliminate the customer, we'll see those journal entries. So on December 15th, 2022, the company recorded 150 sales on credit. On credit means on account, and it means we're going to receive the money some other day. Now, I don't know what the COGS is, so I guess we just assume that we don't have any. I have no idea. Okay. So then it says at the end of the year, we estimate bad debt expense at $15,000. So we will debit bad debt expense and credit allowance. So just like we would debit supply expense or insurance expense or rent expense, we're going to debit bad debt expense. Our credit is a contra asset. So we used to do depreciation expense and accumulated. Now we're doing bad debt expense and allowance. This can be allowance for bad debt. It's going to be allowance for doubtful accounts. So they're doubtful because we doubt we're going to get the money. You can do it allowance for uncollectibles, or you can just call it allowance. Okay. So on this one, I just gave you the number, 15,000. If this was our only sales for this is like a brand new company, and they're basically saying 10% of the money is not going to be collected, and that's sad. So, okay, we're going on to the next year now, and it says we're going to collect some accounts receivable. So we're going to collect the money. So this is an entry we saw in chapter 3. Cash and accounts receivable. And then it says, after many collection attempts, the company determined on June 15th of 2023 that it would not collect $10,000 in accounts receivables from Pindit Publishing and decided to write off this account. Okay, so man, we've been trying. We've been trying for months. We call them. We're like, what up? You owe us money. We might go ring their doorbell. I don't know what we did to collect the money, but it didn't work. So we figured out that we don't think we're going to get this money and we need to write it off. And we have some options. It's my cat. We have some options. We can send it to collections. If we send it to collections, they usually keep at least half of it. You know, we can try to take them to court, but there's legal expenses. And so what we've decided right now is that we're going to write them off. Okay. So when you write off a customer, we've never seen that entry. So this entry is a new entry. This is the year-end adjustment. We will do this at the end of each period. This is the entry for writing off a customer. So when you write off a customer on the second line, we do not think we're going to receive this anymore. So we are going to eliminate the accounts receivable. So we are eliminating the accounts receivable. Now, students want to debit bad debt expense. That's what they want to debit. But we expected this to happen. We knew at the end of last year that we were going to have some bad debt. We didn't know how much, but we estimated and we put it in this allowance account. We have an allowance for this. We knew this was going to happen. So your debit is allowance. And what we're suggesting in this particular problem is we think it's going to happen some more. We don't think we're done here. We thought that 15,000 was going to end up having to be written off. Now we found 10 of it. So we still think that there's some more money that will potentially be written off. So this is always sad, but it happens. So on July 15th, a month later, they called us and they were like, I'm having financial problems, but I can pay $7,000 to settle my $10,000 debt in full. And we agreed. So we reversed the $7,000 and then we receive a $7,000 check from Pindit the next day. So, hey, back off. So love you. So when they call us and they're like, hey, we're having trouble paying our bills. We're like, we know, because we've experienced this situation with you. And they want to give us $7,000. Now, we could say no, but having $7,000 is better than not having any. And when they call us and they're like, hey, we'd like to give you $7,000, we don't say, oh, we already wrote you off. Don't worry about it. We wrote them off, but they don't need to know that. And so if they want to give us some money, we'll take their money. Okay. So, like my dad used to be in business for himself and he's been out of business since I graduated from high school. So I don't know, 25 years, whatever that's been. And he still will tell me every time we drive to town and we drive by this one guy's house, he'll say that a-hole owes me $784.92. He still says it like every time. And so if that guy showed up at his house and was like, hey, I owe you, I'd like to pay you, my dad would take it because he remembers and obviously he wants his money. Was it written off? Yeah, a long time ago, but you would always take the money. So, okay, so the first thing, so when this happens, when you had somebody that you wrote off and then they come back and they're like, hey, I want to pay you. When that happens, you reverse the write-off. So you do it in 2 entries and you reverse the write-off and then you show the money coming in. So we have to unwrite off the customer. So what we do is we reestablish them as a customer. Now that doesn't mean that we're going to let them charge again, but we need to bring it back in as a customer and then show the money coming in. So what we do is we do the exact opposite of a write-off, and I call it an unwrite-off. So I am going to debit accounts receivable to recreate them as a customer. And then I'm going to show the money coming in. So I will receive the cash of $7,000 and credit accounts receivable. So what you'll notice is this accounts receivable cancels this accounts receivable out. So when I was a student, I used to argue about this and I was like, can I just put it in cash and allowance and skip the other part of this entry? Like just say I received cash and it goes back in allowance. And the answer to that is no. And that's because we need to run it back through accounts receivable so we can keep track of what customer paid us. So we know what customer we got money from. And so, but I argued with that too. I was like, I don't think I need to do that. But this is how we do it. So we unwrite off the customer and then we turn around and receive the money. And so, so cash came in, and so this accounts receivable cancels out with this accounts receivable. So, all right. And then it says post the transactions. And so after I do this, I think I'll stop this video. So just a second here. So what I want to know is what is the balance in accounts receivable and what is the balance in allowance? So I'm going to zoom out a little bit so I can see the transactions up here. So I'm going to start off. What I'm wanting to know is the balance in accounts receivable and allowance. I'm not really worried about cash or bad debt expense or, you know, other stuff. I just want to know the balance in accounts receivable and allowance so I can know the number that goes in the balance sheet. So I'm going to put 150,000 in accounts receivable from transaction 1, and then that's revenue, bad debt, allowance. I'm going to put 15,000 in allowance as a credit. All right, next entry 3, I'm going to reduce accounts receivable by 100. Entry 4, I'm going to debit allowance and credit accounts receivable. Because that's money I didn't think I was going to receive. And then in entry 5, I'm going to put the 7,000 back in accounts receivable and put the 7,000 back in allowance. And then I'm going to receive the 7,000. The other side of that's cash, and I'm not worried about cash because what I'm trying to find is what's called net accounts receivable. Okay. And it's also called the net realizable value. And to find that, we're going to find the balance in accounts receivable and the balance in allowance. And you're going to do that in the homework. So let's find the balance in accounts receivable. 150 and 7 minus 100 minus 10 minus 7. So it looks like I have 40,000 sitting in accounts receivable right now. Double underline that. And then over here, I had 15, but then I reduced it by 10. But then I increased it by 7. So I still got 12 in there. Man, I'm still expecting a lot more bad debt to come in. Hopefully it doesn't. Hopefully we have no more bad debt. Okay, so the net accounts receivable is accounts receivable minus allowance, which is 40,000 minus 12,000, which is 28,000. And that you'll have to do that number for homework quite a bit. So I just kind of wanted to give you a heads up that that's something that you're going to compute. So this is the number that would show up on the balance sheet as what we expect to actually receive. So, okay, I'm going to stop there and I'll do the second half of chapter 8 separately. Chapter 8 will be a fairly short chapter. So, all right, thank you.